Alright, so that's another episode of Blockrevision. Today episode is with video lagging, a bit lagging as you can see. That's why I will turn off my camera in the second part of the video right after intro. But we are about to fix this issue very soon, so from tomorrow I hope that all things will be eventually managed. So in today's episode I would like to share with you my point on the current state of markets, where we are right now, as we are right now drifting firmly toward recession, and I could find that this exactly is something that bother many of analysts, and my stance is that you should better not burst out crying, but better watch out for opportunities, as the bear market is typically the one of the phases of the markets that are reached in many of market occasions. There is outstanding volatility that may outcome in an outstanding results at the end. So, not getting this longer, let's begin. Alright, so in terms of economy view, we are getting straight into a UK markets that been recently sent into meltdown. So we've seen a real panic on the UK's market. Economists condemned the proposed tax cuts as fiscally irresponsible, given the UK facing an inflation-fueled cost of living crisis. It's not about the tax, I would rather say, because cutting taxes is nothing really bad. But in the current situation where those DXY index is surging, and that pace we've seen recently that typically lead to much of a undesirable behavior on the markets. So traders were ramping up bets on the scale of interest rate hikes by the Bank of England, but even those ramp up bets couldn't really stop pound from dropping. Right now, the probability of sliding to parity by many analysts with the dollar hits 60%, and the currency has literally been treated recently as one of emerging markets. But as we are dealing with the very strong economy of UK, one of the countries of G7 union, that's really outstanding circumstances. And this recent drop, this panic, I would say, has led us to even more anxiety regarding what may happen next to the global markets. So typically it's when it hits that strong economy, relatively strong economy, this panic may roll over around many of economies. Not, I would say, among them there will be more out of the G20 union and so on. So right now the question is how to tackle singular currency intervention. Would only be a solution for a few minutes. The Japan's Bank of Japan confirmed this. So it may add to longer term hardships. We need structural changes, and for this one to happen, the UK's economy should be more resilient to the circumstances as energy dependence and also broken supply chains that have been recently observed. So UK cannot really stand up on their feet after this Brexit. It's already 6 years through, and we still haven't made it up. So in such nervous environment, we may expect that will be, for now, at least for now, more elements that will gradually fall apart. Is it time to be bullish? Looking at AAII, US investor sentiment bearish readings, we can find that we are right now at the levels haven't been seen since June. So the market is getting more and more fearful. Right now we are in a that bearish environment that it even might be bullish. But in order to generate a pivot, we need a catalyst. Recently, we've seen we are right at the level that goes at par with the previous bottom of June. So the amount of traders betting on a rebound out of this area may possibly rise, and that's the technical analysis might be such booster. But in the longer time horizon, we are eventually in a one of the phases that resemble those 70s times, with very high inflation, and the inflation that raised up to 9, or in some countries over 10%, may last, as history shows, over 5, even 10 years. So problems with inflation is that it typically, in order to suppress this very high demand, we are starting to hike interest rates. And in the 70s, that was this famous Volcker's move on the amount of a couple of percent that really devastated the market. The problem with interest rate rise is that investors must increase the discount rate they use to determine the present value of future cash flows, or other putting this in other view, or interest payments tied to a given stock or bond. So since higher interest rates and inflation are essentially a tax on these future revenue streams, investors typically compensate by assigning a lower valuations. So some of the projections show that when one makes an investment, one puts a lump sum payment for future cash flows, then in order to say what they were worth, we take the present value and we use a discount rate, and that's what makes all boats rise and decline together. So with this interest rate hike, those valuations are more prone to bigger discounts, and there is also room for bigger correction in US households. Aggregately, financial asset allocation has surged to 40%, and this one shows that we are still on the possible way to move lower. Recently, those tendencies of lowering those percentage of money being kept by US households in financial assets been dropping, but this stimulus effect has brought the other. However, with this stimulus being grabbed, I would expect also the households may decrease their portfolio asset, financial asset portfolios. So it may also bring to a result of lower valuations in the future. Are we on the cusp of recession? These leading indicators we yesterday's revolve around right now at the lowest mid-cycle slowdown levels, and there is time to decide whether we're going upwards, make a pivot, or downwards. However, by now there are no many catalysts in order to make such revert. OECD leading indicators turning points showing that right now if following that path, we may be still on the way to move down. So the downtrend looks unabated. The base case still has to be a situation in which the US economy fails into recession. In terms of the leading economic indicators, we are right at the level separating mid-cycle slowdowns from recession, and with the slope of the line aggressively negative, it will take a remarkable turnaround to stop here. So decline in shares is all about rates right now, and those are possibly not stopping for anytime soon. Also, another leading indicator, higher real yields continue to weigh on equity valuations, and S&P 500 is following that US 10-year tips yield path. So definitely the question number one is when the Fed will eventually put their foot off the pedal, and with those problems, those elements lowering, such as earnings yet to been delivered, earnings estimates for next year might be still too high. They really haven't come down yet, and as that happens, we may go into have further equity pain, and because in addition to the multiple coming down via the yield mechanism, so the earnings we are applying that multiple to going to come down as well. So current levels of equity valuations might not fully reflect related risks, as I've mentioned. This is a very interesting chart that's also finding it's kind of a model that finding we are relentlessly heading into recession. So those earnings releases that will take place in Q3 of 2022 will see managements possibly very cautious and sell-side analysts very tentative to boost numbers if the market remains in its current state. The surging dollar hurts the value of US companies, and also we can observe that Morgan Stanley recently has projected that every 1% change in the dollar index has a negative 0.5% impact on profits. Cash flows of companies supposed to be discounted, and that's something that also we can read with this model. So there are serious worries over economic growth that have now percolated for months, but incipient weakness in the industrial cycle will deteriorate possibly more quickly. So a global recession probability model showing that we are right now in a very difficult path ahead. Also, leading indicator that is relentlessly atrocious for bull is the supply of completed homes that is rising, possibly leading builders to begin discounting prices. Capex outlook, usual cycle leads lags. That's also very interesting, as the Fed's forecast is an implicit admission that a recession is likely unless something extraordinary happens. Right now, we are still on the path to revert in a kind of a very firm fashion. Fed showing that after those projections of an expand of the economy at the amount of 1.7% in the beginning of the year, right now is dropping this one to 0.2%, and that's also something that we need to take a notice on. And we are right now in the place where the largest and the most rapid withdrawal of liquidity in history take place, from a peak of around $4,260 billion on December of 2021. Right now, this amount is going to get gradually off the table of the system, bringing reserves down to 3 trillions currently, and QT will continue at 95 billion per month. So there is definitely something to consider, as some headwinds will eventually hit the economy, and many of companies will get battered. So as it was back in 2008, Fed misjudged the risk of subprime. In 2021, misjudged the inflation, and this year is misjudging the slowdown in growth. But recently even has strengthened its narration, and Fed definitely at the end demonstrates incompetence regarding even this. Fed demonstrates incompetence in properly judging reality and applying the wrong policy. It remains the greatest danger. So Mr. Powell, in my opinion, is trying to spook the market by now, but he might be bluffing. He's trying to scare investors for sending them worsening outlook on the economy to slow down its demand artificially. So they want to avoid the necessity of breaking something, but they cannot rise interest rates. They cannot rise interest rates infinitely. 5% is everything what they can get at most, as the debt would be too difficult to service. So that's definitely the pain to happen on the market. During the great financial crisis, this pivotal moment was TARP, this bailout that eventually has spread over the economy and saved many of the companies from getting bust. What will happen this time? It's still way ahead. So those gauges saving the market's bacon, and that's something that really showing us that there are some of the gauges that still going well. Personal savings rate is maybe the low level, but it's not something that may worry many of us. United States consumer credit change also is on a positive territory. So we still have hope that those doomsdays may not come eventually. So as long as we are trusting that we are getting out of this problematic situation, that long we might be defending the possibly doom scenario. So by now, however, nothing is about to come to rescue us from inflationary demon that have been let out by central banks, belatedly woken up to the extreme need to stamp out demand, and that's why that's difficult to consider that will be eventually soft landing. In terms of market outlook, let's get here equity net long positioning. That's another one that's showing us that we are right now going through a difficult time, whereas that might be also the pretext for rebound, as this positioning is that low. And that's Goldman Sachs recent path trajectory. If we manage to go through soft landing, those lows will get us at 3,600s, whereas this hard landing may brought us to 4,300s. Let's now get to crypto outlook, and definitely the dark clouds over crypto sector still persist. We are right now in the midterm of a prosecution of different algorithmic decentralized structures. This time we are facing the DAOs regulations consideration, and it's clear that the CFTC believes that anyone who participates in governance of a protocol, this decentralized anonymous organization protocol, even on occasion, should be held liable for activity on the protocol that violates laws that the CFTC enforces. So even if we just consider that a DAO is just the protocol and that cannot be ruled by anyone but by this community, I would say it will be very difficult for CFTC to enforce any kind of specific regulations on that, I would say, intangible thing. So I wish many luck for CFTC to manage those regulations. I find it eventually happen, but hopefully there will be such rules that won't really destroy the ingenuity and also the freedom of those structures. That's why I do really count on kind of a ease regulations if necessary. But it's also worth noting that from those resolutions that may be in the spotlight, may the fate of Bitcoin and Ethereum depend upon. So a Bitcoin is merely a protocol, but if we have found such rules that recently been taken out regarding Tornado Cash, that was a protocol and was indeed the first protocol being sealed by US regulators, that's something that doesn't really bode well for the whole sector. I hope that are just the dark clouds that eventually go away, but it's still we might not be even in the halfway through. In terms of market movers, let's get not jumping to trade idea, but stopping for a while at this economic calendar. And here we have had, let's change the impact to stars to make it more important events to look through. And on Monday we had PMIs from different. I just switched to recent data. Oh yeah. So that's recent, or maybe let's have a look at previous week, as we haven't discussed that one. So we had from US PMI still over 50, and that's something that still giving us chance to make a pivot around this area. I do expect that markets will react to this recent gauges and rebound here at least for a while. In terms of this week, I need to switch it once again. In terms of this week, we have had IFO business climate at 84 points, and that's definitely below expectations that usually take us at around 90ish, even to hundreds level that was noted during October-November time of the previous year. And as of next, we had today durable goods orders. That's one of the leading indicator that's showing that right now we are entering a bit more difficulties than normally. There is second consecutive in streak negative gauge being shown. New home sales is showing that so expectations, as we haven't have it published yet, the expectations are at lower 600s levels. We have broken down of this very, very strong trend that lasted throughout more than 10 years, and right now we are in a real trouble that haven't been registered previously since 2009. So that's something that we should observe very carefully. On Wednesday, we have another home gauges, wholesale inventories, and consumer confidence out of Germany. Thursday, that's very important in terms of initial jobless claims to watch, and also GDP growth rates. And we have on Friday many GDPs as well, with some inflation rates year over year. So that's it from market movers. Right now, let's jump to trade idea. For this, I have for you another next time. This time, once again, it's gold. So gold recently performed quite poorly, but with this poor performance, I don't find that this lowering tendency might be over yet. Right now, look at this correlation: gold price versus US Treasuries. With US Treasuries being taken down in the next months, we may expect the price of gold to follow. As a next, funds sell gold, and we can observe that money managers hold largest bearish position in almost 4 years. So the tendency right now is that we are right now heading through some of a bear market for gold, and for this one on the chart, we would better look for specific areas to catch the pullbacks. For this one, it will be very important to not get squeezed. That's why we are finding the areas of a lowest possible risk to take. So with every single bounce to the upside that end up at previous support, that will be eventually a good position to take a trade. Previous trade has turned out successfully, and that's why we are finding out the next one to take. If we just try to make a bet on, or rather against, gold, there is definitely one of the spots around here. There is kind of a resistance, or rather support, that supposed to stop the gold that has recently been broken, but we are testing out this exactly line from the bottom. That's why there is a great spot to take a position against this this commodity. For now, however, I did say that gold is correlated with stocks in some terms. Right now, US 100 is rebounding firmly, and I would expect US 100 to rebound and stay here for a while before making new lows. So I do expect that gold might be in a reversal for a couple of hours or even a couple of days, and we may get through recent resistance, but I would start my position to the downside exactly at those resistance and those levels we are right now at. Another add to my position will be met at when we hit those another resistance around 1% higher. So if we manage to hit those levels of 160-ish, 1660s, that will be definitely even better spot to take a position against gold. But in terms of the first position, I would consider this one to trade like this with risk-reward ratio. I will just count it up. Let's see where this, oh yeah, that's the possible support that should turn up here. So with this one, I do find risk-reward ratio at 2.6, and if we manage, I just thought that divide this position into two sizes. With this one, if we manage to go through this recent resistance, that will be very, very, oh, we can even switch it and adjust it accordingly to the move. So when we divide this size of our trade into two pieces, the first one trade will take place at around levels of 1640-ish, with this area of a trade inside of the price range of this blue box. However, another one will take place at 1660-ish, and with the possibly trade area of that. So that's my point on gold dollar. For now, there is generally a bearish outlook on many of assets, so the gold is just one of them, but definitely there are more. Gold, however, formed a very clear structure inside of which I would expect we will go downward further. So today, without content of traders charts, just showing you up that type of charts that just prompt me to follow that point of view and present you the possible proposition of a trade. So that's it in today's episode. Thank you very much for watching, and see you tomorrow at 8:45 exact. Bye bye.